Dividend stocks versus growth stocks. Which makes you richer in the long run? Imagine this. Two friends, Sarah and Michael, both start investing in 2025. Sarah chooses dividend-paying companies like Coca-Cola and Johnson & Johnson. Every quarter, she gets a little thank you in the form of cash, dividends. Michael, on the other hand, picks fast-growing companies like Tesla and Amazon. They don't pay him a penny in dividends, but their share prices can skyrocket. Fast forward 10 years. Who do you think ends up richer? Sarah with her steady stream of income, or Michael with his high-growth bets? In this video, we're going to break down dividend stocks versus growth stocks, explain what they are in simple terms, their pros and cons, and finally, figure out which one is best for you, especially if you're a beginner starting in 2025. Let's start with dividend stocks. Think of a dividend stock as a fruit tree. You plant the tree. That's buying the stock. And as it grows, it gives you fruits every season. These fruits are your dividends. You can pick them and enjoy them, spend them, or you can take those fruits, plant the seeds again. That's called reinvesting. And now your garden grows even faster. Companies like Coca-Cola, Procter & Gamble, and Johnson & Johnson are classic dividend stocks. They share a portion of their profits with you because they're stable, mature businesses. Pros: you get regular income, usually every quarter. Less volatile compared to high-growth stocks. Great for retirees or anyone who wants passive income. Cons: growth is usually slower. They're like old, steady trees, not wild bamboo. Dividends can be cut in bad times, for example, during recessions. Taxes on dividends can reduce your net return, if not in a tax advantage account. Example, let's say you buy 100 shares of Coca-Cola at $60 each. That's a $6,000 investment. If Coca-Cola pays a 3% annual dividend, you get about $180 every year just for holding that stock without selling it. Now let's look at growth stocks. Growth stocks are like young, fast-growing plants. They don't give you fruits right now because they're using all their energy to grow taller, stronger, and bigger. Companies like Tesla, Amazon, or Nvidia are growth-focused. Instead of paying dividends, they reinvest their profits to expand their business, build new factories, or develop new products. Pros: potential for big price increases over time. Good for younger investors who have time to ride out the ups and downs. Often linked to new industries or technology. Cons: no regular income. You only make money if you sell the stock at a higher price. Can be very volatile, up 20% one month, down 30% the next. If growth slows, their stock price can fall hard. Example, if you bought Amazon stock in 2015 for around $300 and held it until 2021, it went over $3,000, a tenfold increase. But during tough times, it can also fall by 40 to 50% quickly. So, which is better? Let's compare them side by side. Income now versus wealth later. Dividend stocks give you income now. Growth stocks delay your gratification but might give you more wealth later. Stability versus volatility. Dividends are often from big, stable companies. Growth stocks are often riskier, but with higher upside. Who therefore? Dividend. Retirees. People who want cash flow. Conservative investors. Growth. Younger investors. People with higher risk tolerance. Those who don't need income today. Mini scenario. Sarah invested $10,000 in dividend stocks with a 3% dividend yield and average 6% annual growth. After 10 years, reinvesting her dividends, her portfolio grows to around $18,000 to $20,000, and she's been getting passive income along the way. Michael invested $10,000 in growth stocks, averaging 10% annual growth, but no dividends. After 10 years, his portfolio might be worth $26,000, but with bigger swings along the way and no passive income. Who's richer? Technically Michael, but Sarah had less stress and consistent income. The truth is, neither is better for everyone. It depends on your goals. If you want passive income and lower stress, go with dividend stock or dividend-focused ETFs. If you're young and can handle volatility, growth stocks may give you higher returns in the long run. And honestly, many smart investors do both. A balanced portfolio with some growth stocks and some dividend stocks is a powerful combination. A popular beginner strategy is to start with dividend ETFs like VYM or SCHD for stability and add a few growth companies like Apple or Nvidia for higher upside. So here's what you should do next. Decide what you value more, steady income or higher potential growth. Start small. Even $100 to $500 is enough to begin. Reinvest your dividends if you choose dividend stocks. Let them compound over time. Don't go all in on just one type. Diversification is your best friend. Remember, investing is a marathon, not a sprint. Sarah and Michael both became wealthier than if they had done nothing, and that's the real lesson here. Thanks for watching. If this helped you understand dividend stocks versus growth stocks, make sure to subscribe and tell me in the comments, are you team dividend or team growth?